Thanks for joining us at xm.com for the week ahead. I'm Christina Marujas, and with me today is our senior market analyst, Haralambos Pissouros. Haralambos, let's start with the United States. Trump's tariffs added to the dollar's weakness this week following last week's NFP report. Now, with CPI inflation data and retail sales coming up, could the dollar gain some ground this upcoming week?
Hello, Christina. Yes, indeed, the soft NFP report combined with the weakness revealed in the ISM services PMI, and also Trump's reciprocal tariffs have revived recession fears and weighed on the US dollar. Investors have adopted a more dovish stance on US interest rates. They are now fully pricing in a 25 basis point rate cut for September, while the total number of basis points expected to be reduced by the end of the year has risen to 60. Now, with regards to next week's CPIs, although manufacturing prices slowed in July according to the ISM survey, the non-manufacturing prices subcomponent revealed strong acceleration. So, given that the manufacturing sector accounts for only 10% of US GDP, this means that the risks surrounding the CPI and PPI data may be tilted to the upside. Therefore, hotter than expected inflation, even before the reciprocal tariffs enter the equation, could prompt some traders to remove some basis points worth of rate cuts from the table. However, should Friday's retail sales reveal that the economy is struggling more than expected, I believe that expectations about the September rate cut and another one by the end of the year are likely to stay firm, which could keep any CPI-related dollar gains limited and short.
Now, there's only one central bank meeting on the week's agenda. The Reserve Bank of Australia is widely expected to cut rates by another 25 basis points on Tuesday. So what could that mean for the Aussie?
Yes, the RBA is expected to cut at this meeting, while another 60 basis points worth of reductions are factored in by June 2026. Now, at the previous decision in July, policymakers kept interest rates on hold, but the decision was not easy. There was strong division, with some members arguing that a rate cut was appropriate. Now, since then, the quarterly CPI data revealed that headline inflation slowed to 2.1% from 2.4%, just a tick above the lower bound of the RBA's 2 to 3% target range. So, with inflation in the target range and also cooling within that range, policymakers are likely to feel more confident to press the rate cut button this time. And thus, given that such an action is fully priced in, I believe that Aussie traders are likely to quickly turn their attention to the accompanying statement and the new macroeconomic projections. They may be eager to find out whether the next decision, the September decision, will be also live, or whether a November follow-up rate cut will be telegraphed. Now, currently, economists believe that November may be a more appropriate time to take the cash rate back to more neutral levels. So if this is the RBA's message, the Aussie could gain somewhat, and its broader outlook is unlikely to be shaken. I believe for that to happen, Wednesday's wage price index for the third quarter and the employment report for July on Thursday may have to disappoint to a degree where traders start speculating about a September rate cut, despite the bank signaling otherwise.
I see. And finally, crossing into the United Kingdom, pound traders are likely to shift their focus to UK data after the hawkish Bank of England meeting we had. With employment data for June and the preliminary quarter two GDP numbers coming up, how could we see the pound perform this upcoming week?
Now, yesterday, after a second round of voting, the Bank of England decided to cut interest rates by 25 basis points, with 4 members voting for rates to remain on hold. That was the huge surprise. Officials also revised higher their inflation projections, while Bailey said that it is important they don't cut rates too quickly or too much. Now, the outcome, in my opinion, gives September pause vibes, and should next week's data come in on the bright side, that view will be solidified and pound traders may push the British currency higher. Currently, investors are fully pricing in the next quarter point rate cut by the Bank of England to be delivered in February 2026.
Haralambos, thanks so much. This was The Week Ahead here at xm.com.